It's time now for today's strategy session. China retaliating against U.S. tariffs today by imposing 34% tariffs on all imports of U.S. goods. What other areas could we see retaliation? We'll see. One question traders are debating is whether foreigners might scale back Treasury purchases. China and Japan will be particularly scrutinized. The two countries are the largest overseas owners of U.S. sovereign debt, with China already trimming its Treasury stockpile for 3 straight years based on the latest U.S. government data. Joining us now, Ed Al-Hussainy, Columbia Threadneedle global rates strategist. Ed, what a couple of days.
Good morning.
Here. It's pretty extraordinary to see nothing working, even gold, but people, when they're looking for safety, are looking to Treasuries, seemingly. How does that strike you at a time when there is so much turmoil? Is that how things are supposed to be working in a way?
I think in many ways that's fantastic news for investors. There was always this question out there about whether Treasuries had lost that hedging property against equities. 2022 was not a good year for a diversified strategy. And what we've done since is we've brought inflation down, and we're starting with relatively high yields. Again, this was last week. But we are starting with relatively high yields. And so for investors who have diversified their portfolios across risk and treasuries, they are in a really good place right now.
What, if anything, could break the bond market as a hedge for risk right now?
The biggest issue is unanticipated inflation. And so what's striking is even though tariffs are at the center of the story, they are going to generate some inflation in the short term. The bond market's taken the view that this inflation will be overwhelmed by the downside risks to the economy. If it turns out that this is not the case, that the Fed has to stay on hold, in the extreme that the Fed has to hike into this environment, that will be very damaging for portfolios and obviously very damaging for the real economy as well.
And yet there's still a lot of debate over whether the Fed can even cut in this environment, right, because of the tariffs. So how is that going to play out as the year goes on?
I think the Fed's calculus at the moment is roughly trying to weigh whether these tariffs are going to end up in inflation expectations versus the downside risk posed by financial conditions tightening very rapidly, lots of red on your screen at the moment. That's going to filter into the real economy in the coming quarters. And at the moment, I would say it's very likely that the Fed's going to look at financial conditions and say those things are going to dominate. That's a material risk to employment, and that's going to be our guide into the second half of the year.
So you think they focus more on the unemployment part of the dual mandate than inflation?
I think that's right, and that's roughly what the bond market is sniffing out at the moment.
Yeah.
What about the risk that we talked about in the intro? That is, you already have China imposing these 34% tariffs. They could, in theory, say, we're going to pull back on our Treasury purchases. What's the risk of that, and what does that do?
I think the good news for Treasury market investors is that the marginal buyer, really over the last decade or so, has been domestic here in the U.S. Foreign buyers have been stepping back from the Treasury market really for the better part of the last decade as well. There's still major holders. Japan and China really stand out as major holders of Treasuries. The odds that, as a matter of strategy, they're going to step back and sell Treasuries, I think, are very low, really for 2 reasons. One, they need those dollar assets in the event that there is a financial crisis at home. These are very important safe haven assets for that system. And 2, if they sell Treasuries, they're going to incur those losses. So it doesn't make a lot of financial sense for them to do that, not at this stage.
Can we talk about the dollar as well, particularly as the global reserve currency? I guess, first, can you just walk our audience through, it's a pretty good deal to be the world's reserve currency, right? So we don't necessarily want to lose that status. Can you explain why?
Yeah, absolutely. And it ties into the Treasury question.
Yeah.
The world is very willing to give us their excess savings, and we're very willing to take them and absorb them into our Treasury market and into our risk assets. And that allows us to live in an environment where we invest more than we save. That's not the case in China. It's not the case in Europe. They send their savings to us. And that's a very fortuitous environment for U.S. taxpayers because we're able to sustain relatively large fiscal deficits that are partially funded by these foreign investors that keep our rates relatively low.
Does the president's tariff strategy depend on a stronger dollar? And the dollar is not strengthening, it's weakening.
You know, on paper, theory would tell you everything else held constant, if you impose tariffs, that will ultimately strengthen the dollar. You're importing less, you're exporting less. Ultimately, that's going to strengthen the dollar. Unfortunately, in today's environment, we've arrived at a point where markets are now looking at a higher probability of a recession, higher probability of Fed cuts, and that's ultimately weakening the dollar in this environment. So the dollar at the moment is actually exacerbating the impact of tax cuts into the year. You should never rely on the dollar to offset these policy risks.
So when you take a step back, there's a lot of investors who we speak with who say that they think that this is going to be okay because we're going to get negotiation, we're going to get tax cuts, we're going to get policy sweeteners. Where do you stand on that right now, Ed?
It's a little bit tough. In essence, we're raising taxes via tariffs. We're cutting taxes potentially later this year through the tax code legislation.
Or at least extending the existing cuts.
That's right. We're going to extend them. We might do a little bit more.
There might be more, right?
There might be a little bit more. And by the way, the more damage the tariffs do, the more likely it is the Congress is going to add those sweeteners in later this year. You know, the problem is that the scale of the disruption, and it's unfolding in real time here, is really hard to control. And so odds are rising that the economy won't be able to handle the shock without significant fiscal support, without significant monetary support. And that's not really a good place for us to be.